Hello everyone, thanks for checking out my video. US stocks briefly hit record highs last Friday before reversing course to close lower. This pullback was likely driven by the latest labor market, which showed that the US job growth is cooling more than expected, boosting hopes for a rate cut this month, but also sparking some economic concerns. That said, last Friday's turnaround and subsequent sell-off didn't do much damage to the weekly returns, as the S&P 500 and Nasdaq still closed the week with gains. Notably, all three major indexes hit fresh intraday record highs during Friday's session, highlighting just how resilient the current market is. But at the same time, this also raises a key question on everyone's mind. Will the upcoming rate cut fuel economy growth, or is it a signal that there is some trouble ahead? Without further ado, let's break down what's really happening in the markets right now, and do watch till the end for more insights, okay? Alright, US stocks closed lower last Friday after a weaker than expected US jobs report sparked concerns about a slowing economy, even as expectations for a Federal Reserve rate cut solidified. The US economy added just 22,000 jobs in August, and that's way below the 75,000 that economists had expected. The unemployment rate also rose from 4.2% to 4.3%, though it's still in line with market expectations. Investors may have been even more concerned by revisions to the June and July data. Combining them together, the report suggests that over the past 3 months, the US economy has added fewer than 30,000 jobs. Specifically, June's revisions even showed a slight contraction, and this is the first labor market shrinkage since 2020. This slowdown in the job market has strengthened expectations for at least a 25 basis point rate cut at the Fed's upcoming meeting. According to the Fed Watch tool, the market is now pricing in a 100% chance of a rate cut, which is unusually high. I can't recall seeing this in recent times. Just to add, some traders are even pricing in a 50 basis point cut. Overall, slower job growth, rising unemployment and moderating wage growth have caused some investors asking whether the economy is genuinely slowing. And of course, President Trump has come out again to criticize Powell for acting too late. So the big questions remain: is Powell really behind the curve? And is the economy truly showing cracks? I will cover this in the end thoughts section. In terms of the market outlook, all eyes will be on the CPI data in the coming week. The latest inflation report will be out on 11 September, Thursday. Investors are eager to see whether inflation continues to cool or if the stubborn price pressures persist. A lower than expected CPI reading would likely strengthen expectations for a Fed rate cut and could even spark speculation of a larger cut, potentially giving the stock market a huge boost. On the flip side, if inflation comes in hotter than expected, it could create a tricky situation for the Fed. They would face a tough balancing act, supporting the labor market while keeping inflation under control. Along with CPI, the Producer Price Index (PPI) will also be released this coming week. In case you're not aware, PPI measures inflation at the wholesale level, providing an early signal of price trends before they reach consumers. Meaning to say, rising PPI numbers could indicate that inflationary pressures remain entrenched, while a slowdown may hint that the consumer-facing inflation numbers could soften in the coming months. With the FOMC meeting coming up later this month, these data points are crucial for shaping expectations around rate cuts. Markets are currently pricing in a very high probability of at least a 25 basis point cut, and some are shouting for a 50 basis point cut. So, a stronger than expected inflation readings could temper those expectations. Let's now move over to the technical analysis segment. Despite all the talks about a bearish September and a slowdown in the economy, we saw yet another all-time high in SPY last week, which represents the broader market. But then we saw a little pullback last Friday, and at this point nobody can tell you accurately if it will continue this week or not. If it does, don't be alarmed if SPY drops towards the first Fibonacci level at around 633. This level should offer a decent support because that's where the 50 moving average is as well, thus we can call it a double support level. And as you can see, SPY has bounced off this level twice recently. So in other words, so long as SPY bounces off this level, or better still, the pullback doesn't reach this level, then this whole bullish momentum is still very much intact. And from there, I wouldn't be surprised if we see another new all-time high. On the flip side, if SPY breaks and closes below this 633 level, then maybe, just maybe, the bearish September trend could be emerging. That's when I would expect SPY to continue to grind towards the 38.2 Fibonacci level at around 622. Ultimately, at the end of September, so long as SPY holds above the 50% Fibonacci level at around 613, the market is setting up for a potential year-end rally, assuming of course there are no major unexpected negative events. Moving over to Apple, in my last video I shared that if Apple can close above 236, then the bull flag has a very high chance of playing out. When that happens, Apple will enter the 240s range at the very least. And that was what exactly happened. On 3rd September, Apple gapped up and closed above 236. The next thing we knew, Apple hit 240s range. I hope this analysis could earn a like button from you. Okay, looking at the week ahead, all I can say is that when a bull flag played out, the trend is very bullish. I actually was trying to be a bit more conservative in my last video. That's why I mentioned Apple will hit 240s range at least. But actually, in a so-called textbook bull flag version, the breakout can be as large as the flagpole, and that will bring us to 250s range. But just to clarify, I'm not saying it will definitely happen for this case. I'm saying there are some odds that if this Apple bull flag continues, just don't be too surprised if there is still more room for upside, and we could potentially see 250s range. That said, as always, you got to prepare yourself for both bullish and bearish scenarios, and be flexible to pivot anytime. So where is the pivotal point to judge that the bull flag breakout might be over? Well, I would say two levels to watch. One is the blue resistance turn support line at around 236, which was the point of reference I used for the bull flag breakout. If that breaks, that's your first signal that you should be cautious if you are holding on to long trading positions, because the bull flag pattern could be ending. The second level to watch is the first Fibonacci level at around 232, but I might just stretch it to the bottom of the gap at around 230. So if Apple doesn't bounce off this 230 to 232 area after filling the gap, then we can say goodbye to the bull flag and hello to low 220s range again. Moving over to Tesla. Tesla is one unique stock that sometimes don't quite move according to the company's sales, profits, numbers, etc. Like you got so many negative news pertaining to their market share, sales and whatnot, but yet the stock climbed more than 5% last week. This is why I trade what the chart is telling me instead of anything else. But that's trading. For long-term investing, it's a different story. It really depends on whether you believe in the company's future. Okay, sorry, I digressed. Back to the technical analysis. Tesla is obviously looking bullish because it just did a classic retrace, retest and rebound movement as seen on the chart. On top of this, the bounce was strong with that gap up, and it also hit the recent high of 355. In addition, the MACD had a bullish crossover. But then here's the question, can this bullish momentum continue? I would say pay special attention to this purple resistance line, which is around 356. As you can see on the screen, Tesla got rejected on about 5 occasions. This means if Tesla manages to close above it, the share price could really fly and we could be back to above 365 easily. On the other hand, sorry, a quick one, as always, I'm not gonna take up too much of your time, just gonna show you the different ways that you can support this channel as I continue to churn out free content on almost weekly basis. Feel free to pause the video to go through the details. Okay, back to business. If Tesla could not break above the purple resistance line, then please be mentally prepared that the gap up between 338 and 344 will be filled easily. Note the word easily. Okay, but I'm actually not too concerned if the gap gets filled. My attention will be more focused on three levels, which are the 200 moving average, the critical 61.8 Fibonacci level, and the blue downtrend line. If we combine them together, the range is between 326 to 331. Given how volatile Tesla is, I think a close below this area will almost certainly brings Tesla below the 50 moving average as well, because it is sitting pretty near to the area that I just mentioned, at around 324. In fact, if Tesla goes below the blue downtrend line, I would expect Tesla to hit 320 where the next Fibonacci level is. And if you haven't realized, from 350 to 320, that's a 30 points drop. If that happens, I think you don't need me to tell you that Tesla's trend has turned bearish. Moving on, let's have a look at Google's chart. The analysis for Google will be quite short because, like I always said, at all-time high and uncharted territory, it will just keep creating new record highs till God knows when. So before we reach the end of the run-up, there's nothing much to analyze because we don't know when is the next meaningful pullback. That said, I would like to emphasize again, a bigger than usual pullback will come after a huge run-up. Okay, I repeat, it will definitely come, it's just a matter of time. We have seen that in Meta and Microsoft, so I'm laying it out here first so that viewers don't get caught off guard or be too surprised if Google suddenly falls to 210s or low 200s range. In the meantime, if Google wants to go higher, no one can stop it. But in terms of the downside, there are a few things to watch. First and foremost, it's the 23.6 Fibonacci level at 218. When Google starts to pull back, watch if we can get a bounce off this level. If it does rebound from here, it's actually very bullish because it means the bears cannot even fill the gap entirely. Which then brings me to the next thing to watch, the gap. This gap is between 211 and 224. At one point, I believe this gap will get filled. But what is important now is that after the gap fill, will Google bounce up or not? Coincidentally, the bottom of the gap is where the purple channel is. Alright, what I am trying to say here is that if Google doesn't bounce after filling the gap, it means Google is going back into that channel. When that happens, don't worry yet because we do have a few decent support levels within the channel. Let's discuss those levels again when Google really goes back into the channel. And oh yes, before I forget, just to share, Google's RSI is hitting overbought zone. Not financial advice for you, but personally, I'm not going to add any more bullish trades or positions at the moment until the RSI cools off. Moving over to Meta's chart. Meta has been moving sideways for about 2 to 3 weeks. At this point, there isn't any clear direction as the bulls and the bears are having a tug of war near the 50 moving average level, which now sits at around 738. Towards the end of last week, Meta was trying to reclaim the 23.6 Fibonacci level at around 755, but was unable to do so. So for this coming week, watch this level closely. If Meta can finally close above it, then that's a positive sign. In fact, a close above 755, I would think the probability of filling that tiny gap between 775 and 780 is quite high. From there, if it doesn't get rejected after the gap fill, I do think we can expect to see a new record high soon. On the other hand, in terms of the bearish thesis, if Meta can't reclaim the 23.6 Fibonacci level, then I think it's almost certain that last week's gap up will get filled. This gap is between 740 and 745. At this area, obviously the 50 moving average is the level to watch. Last week, we briefly closed below this 50 moving average by a tiny bit. So for this week, watch if Meta closes below this moving average. If it does it for at least 2 days, I do believe Meta will break that 38.2 Fibonacci level, which means we can say hello to 720's range again. Just to also highlight, a close below 729 could see the large gap acting like a magnet, pulling the stock price lower. The gap is between 708 and 721. I am contemplating if I should take some form of action if Meta does fall to this area. Alright, now let's have a look at Microsoft's chart. The chart is flashing several bearish signals that could be raising some red flags. First and foremost, last Friday's candlestick appears to be a bearish engulfing pattern. The length of the candlestick didn't help either. It is basically telling us that while Microsoft opened higher, even above the prior day's close, sellers quickly stepped in and drove the price sharply lower. To put things in perspective, Microsoft usually doesn't move that much in a single session, which is why most of its candlesticks are relatively small. That makes last Friday's big red candle stands out. The last time we saw something similar, a long red candle with a bearish engulfing pattern, was on 13 August. And after that, the stock kept sliding down and printed 5 more red candlesticks. Another key level to watch is the 50 moving average. Microsoft was rejected at that level last Friday, and for 3 trading sessions before that, it struggled to push above it as well. And if you take a step back even further, you can see that Microsoft has been struggling to go above this moving average for more than 2 weeks. Therefore, going into this week, I would use the 50 moving average as an important reference. If Microsoft pulls a few more red candles below it, I think the share price could fall towards 489, where the 50% Fibonacci level is. If that doesn't hold, then Microsoft is pretty bearish. But of course, the stock market can be unpredictable. If the market sentiment shifts, how do we know my bearish thesis is wrong? Again, watch the 50 moving average. A few strong green candles above it would be a clear sign that the bearish trend might be reversing. And of course, I stand corrected. Okay, at the end of the day, for us to say that Microsoft has reversed its short-term downtrend, it needs to break and close above the 23.6 Fibonacci level, which sits at around 524. Moving over to Nvidia. Wow, Nvidia has fallen 7 out of the last 8 trading days. Not just that, it has fallen below the 50 moving average as well as the first 2 Fibonacci support levels. So I guess I don't need to tell you that the chart is looking bearish, right? Anyway, if you have been following me, you wouldn't be surprised by this 6 to 8% decline considering how much it has run up for the past few months. Like I said under the Google's analysis segment, every monster run up will be met with a meaningful pullback, which is usually more than 5%. And if you were to ask me, Nvidia actually still has room to fall. At the current level, I would pay extra attention to 163 and 157, where the pivotal 50% Fibonacci level and the critical 61.8 Fibonacci level are. So far, the pullback has been healthy, but if somehow Nvidia starts to close below these 2 levels, then we can say that the trend is very bearish, because that's a good 15% drop from the highest point. But then, very bearish doesn't mean I will be very concerned. In fact, I will be excited if I can see Nvidia falling to the 150s range this September. I will almost certainly step in to take some form of actions. In fact, I have already done so through options. More on that later. All that said, at the end of the day, so long as Nvidia doesn't fall below that purple support line, which sits at around 153, I think there is no major concern. In terms of the bullish thesis, it's straightforward. Reclaim that 50 moving average, fill that tiny gap and not get rejected, and better still, close above the 23.6 Fibonacci level at 174. Then, I think we can say Nvidia is on the verge of reversing its short-term bearish trend. Okay, but a close above 174 is nothing to be too happy because we are just going back to this consolidation zone. Alright, moving over to my options trades. Well, the market has been a little volatile recently, and because of that, I have sold a total of 6 options contracts between 29 August and 5th September. That's like almost 1 contract every trading day. Anyway, 3 new trades and 1 existing one to update this week, as I have updated the other 3 new trades in my last video. The first trade is this new cash secure put on Nvidia, which was sold last Tuesday, 2nd September. The strike price is 150 and the contract will expire on 10 October. The reason for selling this put contract is simple. Basically, Nvidia has been falling for 3 consecutive days. Then on 2nd September, which is the first trading day of a traditionally bearish September, Nvidia gapped down at the opening. Many other big tech companies were falling too. To me, there was no real concern that was causing the mini sell-off. It was likely investors taking profits. And the moment I saw Nvidia hit the support level of 50 moving average, I stepped in to sell the put option. Well, yes, Nvidia did continue to fall further and broke below the 50 moving average, but I'm not too concerned. Reason is because, given how strong Nvidia earnings were, I may not mind getting 100 shares of Nvidia at 150 if Nvidia does fall below my strike price of 150 on expiration date. This then brings me to the second trade, also a new cash secure put on Nvidia. This option was sold last Friday 5th September with a slightly lower strike price of 145. The contract will expire on 17th October. So last Friday, Nvidia's stock continued to decline, and at one point it fell by 10% from its recent high, which some might consider it as a correction. Seeing that as an opportunity, I step in to sell the put option as I anticipate a bounce from Nvidia's share price in the next few weeks. The third trade to update is this new cash secure put on Tesla, which was sold last Friday 5th September. The strike price is 270 and the contract will expire on 17th October. Okay, got to be honest, this is not the most ideal trade because I would prefer to sell a put option on a negative day than a positive day. So last Friday, Tesla's share price gapped up and popped at the opening, namely because the news reported that Tesla is offering an unprecedented $1 trillion pay package to Elon Musk. Investors took this news positively because they believe that the pay plan was designed to keep Musk motivated and focused on delivering for the company. And so I decided to ride the bullish momentum by selling a put option as I was of the view that Tesla's short-term bullish trend could continue. Reason being, other than the positive news, technical-wise, Tesla has bounced off the blue trend line as well as the 200 moving average. That's a bullish sign in my opinion. The final trade to update is this covered call on Google. A quick recap, I first sold this covered call with a 180 strike price, but Google kept climbing and climbing, and I didn't want my shares to get caught away right now. So I rolled up the strike price from 180 to 185, then to 190, and right now to 195. The new expiration date is 24th October. Let's see where Google is by the end of October. By the way, I shall also take this chance to mention that please do not follow my options trades blindly. Opening 6 cash secure puts in 1 week can be risky for you, because if the market suddenly tanks like in April this year, you could be at risk of being assigned for all your contracts, and that will require quite a fair bit of cash. For me, let's just say I have put in place my very own risk management measures. Okay, here's the final segment, my thoughts on the current market. As mentioned earlier, one of the biggest questions on everyone's mind is whether Jerome Powell and the Fed are behind the curve. Well, the jobs report shows slower growth and a slight uptick in unemployment, which naturally raises eyebrows. But the job of the Federal Reserve isn't just to react to one single data point, it's about overall trends and patterns. In that sense, I think Powell isn't necessarily late, but he is walking on the tightrope between supporting growth and keeping inflation in check. With the market now pricing in a 100% chance of a rate cut this month, expectations are sky high. A cut could give the economy some breathing space, especially for businesses and consumers feeling the pinch from higher borrowing costs. But if the slowdown is more structural, systemic, or tariff-driven, then the rate cut may only provide short-term relief, not a long-term solution. Going back to the labour market, the revised data for June and July showing near zero or even negative job growth is worth paying attention to, because it is suggesting that the labour market isn't as robust as headlines might imply during the first half of 2025. That said, it's still far from collapsing. I mean, unemployment remains low historically, and many sectors continue to hire, so I would say it's a mixed picture. Basically, slowdown signals exist, but cracks are not yet obvious. Therefore, I think we all should pay special attention to the job market data in the next 2 to 3 months. As for the other question that I wanted to answer, which is whether is there trouble ahead, well, I think the answer is nuanced. Certain metrics such as the 3-month net job creation does suggest softness in the economy, but many core indicators like the overall employment levels and consumer spending remain resilient. In short, the too long to read version is, at the moment the economy is slowing but it's not collapsing, and I don't see major trouble at this point. Personally, I think the bottom line is that the US and Jerome Powell is navigating an economy that is showing early signs of a slowdown but nowhere near a full-blown recession. For investors and viewers, the takeaway is to watch the upcoming CPI and inflation data closely, the labor market report, as well as the Fed's rate decisions. These signals will help to clarify whether this slowdown is temporary or the beginning of a deeper trend. Alright, that's all for this video. If you like my free content, would appreciate if you could just tap the like button and comment something below. Thank you very much.